Hi guys, this is Eddie from Moat Investing, and as you know, we are a group of analysts and investors who like to dig deeper into the stocks, trying to find companies with competitive advantages. And many of you have asked about our valuation approach. Santiago, our senior analyst, is here with us, and he will explain what we mean with our DCF and sensitivity analysis, so you can understand them better. And we will be hosting a course on company valuation where we will go deeper on all these topics and more with different valuation approaches and what's behind them. Keep tuned for the announcement of the course. And now, Santiago, welcome. Please introduce yourself and let's go with the video.
Yes, hi, Hedy. Thank you for inviting me. It's always a great pleasure sharing time and ideas with all of you and with our community. So today we are going to talk about our valuation approach. And I just picked up one of our recent valuation, which is MOK. So the ticker is MWK. We came out with a detailed report and a full video you can find on our platform. So now we are going through the valuation model, how we approached MOC valuation. So basically here, as you can see, we have our revenues projections, which are basically you can either rely on consensus or on any other source of information, or you can make your own projections. So we for our base case, we basically relied on our Bloomberg consensus. So we downloaded figures from Bloomberg, and we just linked revenues and EBITDA in our base case scenario. Here we basically calculate the compound annual growth rate from 2021 to 2030, which is a very important metric for this growth story. So the point which is important to stress when you are approaching a growth story is not the multiples you're paying, but the growth which is already factored into current share price. So as we can see in our sensitivity analysis later on, you can basically build up different scenarios and see what is the compound annual growth rate which delivers a current share price. Clearly, you have to make other assumption on the free cash flow, on the discount rate, and on the perpetual growth rate. But anyway, this is a key aspect when you approach a company. So let's see how we proceed. Basically, once we have calculated our EBITDA, which is again consensus estimate, you can see here, which is linked to Bloomberg consensus. Then we have calculated to which extent the EBITDA is transformed into free cash flow to equity. So in this case, we feel confident with 60% conversion, but this is a point where you have to pay lots of attention, because in some cases this rule does not apply, because we have valid companies where the free cash flow to equity is higher than the EBITDA. This is a peculiarity. Mercado Libre, which is a company we have recently valued, falls in this case. So they have Meli as a free cash flow which is higher than EBITDA. So in that case, you can basically see what is the percentage of revenues which is transformed into free cash flow, and so you get the stream of cash flow to be discounted. Clearly, there is it is important to estimate in the right way the percentage of free cash flow, because if you use an higher than a reasonable performance based conversion, basically you are overestimating the company. And on the opposite side, if the percentage is far below the reasonable expectation, you are underestimating the company. Once you have the free cash flow stream here, we have set our discount rate, which is the cost of equity, since we are discounting free cash flow to equity. We in these cases, we have not relied on a capital asset pricing model, so looking at the beta, the market equity premium, simply because these companies are recently listed on the market, so beta does not make very much sense. There's limited correlation with the overall market. When you value a more mature company, you can eventually go through a capital asset pricing model approach in estimating the cost of equity. So now we feel confident with a 9%, and then we see how we have basically tested what is the valuation by increasing this discount rate. So this is basically the net present value of the free cash flow, the free cash flow we have seen above. So if I open the formula, you see how it is calculated here. There's basically the discount factor we use, which is for sake of simplicity, it is hidden, and the sum of this net present value gives us the first part of the equity value, and the second part is the terminal value. So the terminal value is basically our last discounted free cash flow, which has been inflated at the perpetual growth rate, which is 3%, and is divided by the cost of equity minus the perpetual growth rate. So this is a very simple formula. Pay attention when you calculate this terminal value in order to link it correctly. So you have to link it to the discounted flow and not to the free cash flow above. Otherwise, you will overestimate the terminal value. So it is always important to see also what is the percentage of the terminal value on the total equity value, because this gives you a measure of risk. Clearly, the terminal value relies on a value component you are unable to project and to foresee in the future. So the higher this terminal value, the higher the implied risk in the equity story. So let's pay attention to the amount of value which relies on terminal value. In some cases, we have also seen terminal values accounting for more than 100% of the equity value, because the net present value we project is negative. So that is a major concern, because clearly that company is carrying on a huge execution risk. So then basically we divide by the number of shares, which is fully diluted. So we take into account potential future dilution represented by warrant, convertibles. We have to take into account the fully diluted number of shares. And basically here when we made this valuation, the stock was trading at $33 per share, so the upside was 50%. So now let's go through one of the most important part of the valuation, which is the sensitivity. What does sensitivity mean? So basically we test here what happens to this per share value once we change the discount rate and the perpetual growth rate. So I'm going to build this with you in order to show how it is made. So basically, let's assume that you built this layout, which is very simple. So here you have the discount rate, which is basically this parameter. So in this valuation, we use 9%. Let's see what happens if we start, I don't know, with 7.5%, and then we increase this 7.5% by 0.5% each time. I'm sorry, it's 0.5%, and we stretch this until 11%, but you can go further as much as you want. So normally I used to put in red those input in my valuation model, so I know I can change these parameters and all the rest will change automatically, as you can see. On the perpetual growth rate, I mean, we use 3%. Let's start here with 2% and let's increase it by, I don't know, what would make sense would be probably 0. Yeah, that's correct. So we increase it by 0.25%. So this is the G we're testing. Let's put this one in red, so we know that if we change this one, then all the rest will change accordingly. So now basically we're testing the per share price. How does the per share price change if we change the discount rate and the perpetual growth rate? So that's very simple. We put in this cell the price per share. I normally used to put it in blank color because just for an aesthetic principle, because I don't like that this figure would appear on the top left of the table, so I put it in blank, as you can see. Then I highlight the entire table. I go here on the windows, choosing data, what if analysis, data table. Then I am asked to plug the row input. The row input is, as we can see here, the discount rate. The column input, as you can see here, is the G, and that's it. So you have your sensitivity. So basically, we have used 9% and 3%. So you find here 9% and 3%, and that's the price. So let's start here at 7.5%. So we have 9 here, and here we start at 2.25, and we have our per share price exactly in the middle of the table. And we can also highlight the valuation range. Let's do the same with the free cash flow conversion. So same exercise, let's do it again together. So we are testing how the valuation change if we change this parameter and this parameter. So basically here we can start with, I don't know, 45%, and we increase this by 5%, 5%. I'm doing it live with all of you guys, so please apologize any mistake I might do. So let's take the perpetual growth rate from the table above. We put always in the top of the table the per share price we are testing, and that's it, guys. We highlight the table, we go to what if analysis, data table. The row input in this case is the free cash flow conversion, which is here, and the column input remain the G. And here you have your sensitivity. So now let's put this in blank because I like it to hide for main aesthetic purpose that value. And you have your sensitivity. So how do you read this sensitivity? That's the point. Basically, this sensitivity tells you what happens if you increase your discount rate, for example, by 2%, because you don't feel confident with 9%. You believe there's more execution risk you want to factor into the discount rate, and you increase it. So basically, if you go for 11% discount rate and you still rely on 3% G, your target price goes down to $34.4 per share. And what if the perpetual growth rate is lower, let's say 2.5% instead of 3? So the target price will be $33 per share. And the same story here. Basically, if the free cash flow conversion, instead of being 60%, is 50%, for whatever reason, probably they go for more capex, they go for more working capital management, any component which might affect the free cash flow conversion, basically still relying on a 3% G, the valuation goes down from 49.4 to 41.1. So this is an extremely useful tool to basically understand what is the potential risks implied in the equity story. Because by changing the value drivers parameter, you can understand where the risk lies, which is crucial when you look at any equity story. Before trying to understand what is the potential upside, you should look at the potential downside. So because any investor will ask you, what happens if? And here you find the answer. So if the market, or if interest rates goes up and you have to go for a higher discount rate, you can find here how things go, how things will change, and how the valuation is impacted. Here you can plug in 10%, and then you can see what happens if the discount rate increases to 13%. Here you can put 1%, and you can see what happens if you go for a very bearish scenario with 1.5% perpetual growth rate and 13% discount rate. So basically, the valuation is off as compared to what we are currently estimated, roughly speaking. This is a brief outlook on how to build up a simple valuation model. We will carry on. We can touch other angles, like looking at potential multiples, how we have to read these multiples, what is the growth implied in these multiples. We leave these issues for another video. For the time being, we thank you very much for your attention. We are here to address any question you may have, and don't forget to leave a like, as always. Thank you very much indeed. Bye-bye.
Bye-bye, guys. Please don't forget to like this video, as Santiago said, and that really helps. And also subscribe and activate the notifications. And just remember, in the description, you will find an invitation link to our Telegram channel. If you are not already there, please join the community and get advantage of the ideas we discuss over there. Thank you. Bye.